All right. Hey, Jojo, how are you? So welcome everybody. We are, what day are we? We're Wednesday. We're Wednesday. So we have our amazing Jojo with us from House America Financial, and he always gives us, it's always such a treat to have him on and share his wealth of information. He is working or is going to share with us today, Bulletproof Your Buyers, Cross-Qual and Cross-Qualification and Pre-Approval. So Jojo, hey, or do you need to share the screen, right? Probably.
I know how to do it.
Okay, I just want to make sure, Patricia, that we have access for him to be able to do that. Yeah, so take it away, Jojo.
Okay, let's get started. We have about roughly an hour, I think, so plenty of time for engagement and questions. So just like in the past, we'll go over some concepts. I'll pause. I'll share the screen also as we go down each bullet point of today's agenda. But I do welcome lots of questions that you may have, either now or later, so that you can get immersed in all the concepts that we're going to talk about today. If you have joined us in the past, this is actually the third installation in a series of webinars that we did for Mortgage 101. We started out with Mortgage 101, the general landscape of all the concepts and topics that are involved in mortgage lending that affects your clients and the transaction, both on the listing and the selling side. And then from there, we drilled down to each key concepts. We started out with appraisals. I believe if you were here with us, we invited one of the appraisers to speak to us about what appraisal and collateral means and the concepts behind that. We then did credit. I think it was last month we did the credit. We took a deep dive in credit, FICO scores, the bureaus, rescoring, fixing the credit report, understanding what it means. And then today, the third installation, we're gonna take a deep dive on income and what are the vernaculars or the language or the words that are involved in income qualification for a buyer. And so just like last time, take lots of notes and then ask questions if you may. This sheet that I have today for you is also available. I think it's been uploaded to, I think it's Facebook or one of our website by Kim over here, Kim Jordan here in our office. Email myself or Kimberly and we can send it to you later on as well. So to get started, in one of our last webinar, we talked about the 3 questions you should ask a potential buyer, a client, a buyer. And that was starting with, do you know what your FICO score is, your credit score? What is the budget for your down payment? That's the second most important question. And the third, in qualifying a client, is are they currently working, employed, and have they been employed for how many years? Those 3 questions determine whether they are actually a client or a buyer in today's environment for lending and purchases. So now let's take a deep dive. Let's start about the employment piece. In any loan products that you do today, whether it's conventional, FHA, VA, rural, non-QM products, there is a minimum requirement that they must be on the job for at least 2 years, especially now with COVID. Now, it doesn't have to be the same job for 2 years because people do move, they get promoted, they get a better job. As long as it's in related or similar industry within that 2 years, that's acceptable. If they are in one job for 6 years and then a year ago they moved to a new company, if it's a promotion, increased pay, a better job, that's also acceptable. But what they look for is, number one, strength in the 2-year history, and then strength in prior history or how many years have they been employed. FHA is probably the most lenient in that area as far as having the 2-year history and the content of that 2-year history. Conventional is, well, it's about the same as far as what they look for. So 2-year employment history is the first test of the strength of the person's job and employment. And then the second test is it in the same industry, a similar industry, or of some sorts? And sometimes that can face a challenge. For example, I've been working full-time at McDonald's for the last year and a half. And then I graduated college and I became a CPA. So that's not exactly the same, right? But that would be acceptable because there's a upper movement in the employment, upper movement in potential income and potential career. That would be just an extreme example. So just remember, 2 years in the same job or similar industry. So far, so good. I don't see any questions. Okay. Then the next test in employment or in how we review employment and income is the candidate or the buyer a W-2 or a 1099? And what are the difference? A W-2 is a salary or an hourly employee. They get a consistent paycheck month in, month out. A 1099 is typically a self-employed. They own their own business. They could also be corporate owners. So they don't get a steady paycheck every 2 weeks or every month. It depends on the business that they do and whether they be in sales or services. It's a different structure or stream of income. Both are acceptable in the lending world. The way that it's analyzed is different, and that's not something that we're going to go over today. But just know the difference, because what is the hint here? If a potential buyer says they are employed, W-2, salaried, hourly, it is much easier to document the income behind that client. When they fall into owning corporations, sole proprietorship, Schedule C income, which is a business income, you will need 2 years tax returns, and we'll go over that shortly. But it becomes a little bit more complex, not that it's impossible, but it's just a little bit more complex to analyze and arrive at the income to use to qualify the client. So the takeaway here is, again, W-2, salary pay stubs, 1099, self-employed, tax returns, 2 years of tax returns, which takes us to the second or the next concept behind income documentation. Let's start with the reverse, which is the self-employed individual. Today, there is no question, no doubt, that if they are self-employed, excuse me, they will need to provide 2 years of tax returns, and then preferably the last 2 years. So we are in 2020, they would need to show the full tax returns for 2018 and 2019. Now, because of COVID, we have run into problems recently that people have not filed or have delayed or gotten extensions. Here's the hint. We are now in October. They should have filed by now. The majority of the folks out here, self-employed in business, would have already filed. There will be some that have still have extensions for their 2019 returns. To be honest, it's a little problematic if they don't have it. And for two reasons. We are so far into 2020 that most underwriters really want to see what they had income for 2019, because the alternative is they have to go back 2018 and 2017. Although those are 2 years of tax returns, they are a little bit more older or stale as compared to what they have earned now, because 2019 have passed and almost end of 2020. You see the difference? A lot of time has passed, and we want to see that the income either continues or has improved. Because of COVID today, there has been some challenges that business have declined depending on the industry that you're in. So underwriters are more stickier and asking the 2019 returns. What is the takeaway? 2 years of tax returns. In normal times, it would have been 2018 and 2019 because there have been no delays in filing, maybe some here and there, but not a majority. As we move out of COVID into normal environments in lending, it will return back to that, and we will have regular filing times. So self-employed, 2 years of tax returns, the last 2 years. And then let's go to the salaried or the hourly and salaried employee. So what they will ask for to verify their income are a few things. The last 2 years of W-2s. In this case of our example, 2018 and 2019. And they will also ask for the last 2 years of tax returns, 2018 and 2019. And then lastly, they're going to ask for the last 30 days or the last month's worth of pay stubs. The pay stubs will show us what they're making currently, because you must imagine they may have gotten an increase, a pay increase, a promotion. So the pay stub represents that. And we will typically use that income because that is the most current and probably the better income. The W-2 shows us that they have tracked that income, or they have received that income in the last 2 years, consistency and strength of that income. The tax returns will show us that they don't have any kind of losses or any kind of other businesses they're running that's causing their income to reduce via deductions or any kind of passive activity losses and so forth. So those 3 things will be required. And there's really no workarounds on those things. So again, on a salaried employee, 2 years of W-2s, 2 years of tax returns, and the last 30 days of pay stubs for those reasons that I have outlined a second ago. Okay, same questions? Nope. Okay, now let's talk about another concept on the employee salaried individual borrower or buyer. Questions would come up to me, Jojo, they're working full-time versus part-time. So let's differentiate. Full-time meaning they're doing at least 40 hours a week, sometimes more, because they may be getting overtime, and they're working 40 hours a week, 52 weeks a year, no problem, standard. And we will calculate their income out based either on an hourly or a salary calculation. But when you have a part-time position, and I'll give you an example where that happens. A registered nurse will probably or may have a full-time RN position at a hospital, but because they have, good for them, good wages on that position, they may also take in a part-time position at another hospital. That's probably the best example I've seen. Can you use that part-time income? Typically, yes, subject to a couple of conditions. Guess what? One of them is, have they been earning that part-time income for the last 2 years? Number one. Number two, although they probably are making $50 to $80 an hour, depending on the experience of the RN, the registered nurse, it will be an average of that income. Just know that concept. So they will get credit for the full-time employment and the part-time employment if they've earned it for the last 2 years, and we will average out the part-time employment to add. And it becomes very helpful in this scenario, in this example, because it allows them to qualify for more, brings up their purchasing power, gets them into a bigger home or a higher priced home, whatever the case may be. So that's part-time. Some concepts behind part-time and full-time scenarios. We already talked about. One is a salary, in which they're getting a paycheck, 40 hours a week, so forth. The other earning methodology is hourly, whether it's the minimum wage all the way up to $100 to $350 an hour, whatever the case may be in the position. And we do calculate both. Second terminology takeaway today is an employee can get paid bi-monthly or twice a month, or bi-weekly, which is every 2 weeks. What's the difference? In bi-weekly, they actually end up getting 26 pay period or 26 paychecks. In bi-monthly, they get 24. The reason I bring that up to you, because that bi-weekly can sometimes be a stronger monthly income because of the two additional paychecks a year than what you would normally see in a salary, just as an observation. But these things I look for when I qualify. I always ask the client, if they're employee W-2, how many times do you get paid? Is it twice a month or every 2 weeks? It makes a difference. Okay, see if there's any question. Nope. Let's talk about the concepts of debt to income ratio. This is the ultimate determiner of whether your client will qualify for the loan, or the buyer, I should say, either one. there are three layers in debt to income ratio that are commonly used, and I'll share with you what that is, and then we'll define them. 40%, 45%, 50%. These are tiers of ratios depending on the product. Let's start with the 50%. 50% ratio meaning their overall debt, monthly payments that they make, credit cards, student loans, car loans, installment, not including any kind of like utilities or cell phones, plus the new mortgage payment, which we'll define shortly in this session, divided by their income, their monthly gross income, we'll define that in a minute also, falls at 50% or less. That is typically an FHA loan product. It is the most generous, most forgiving in maximizing debt to income ratio. The opposite side of the spectrum, at 40% debt to income ratio, that is the maximum they can be at when qualifying for a jumbo loan. Now, is there some forgiveness? Yes, there is. But if they want the best rate, the best terms, ease in underwriting, so forth, at 40%, that's like the magic number for jumbo loans, magic percentage of debt to income ratio. In the middle, the conventional loan, so what is it, 700, 650,000, something like that and below. That includes conforming and high balance loan amounts, not a jumbo. That ratio is at 45%. So if they float in that area, 44, 45, 46, that falls into the conventional product. And the reason I'm talking about this today is because you will hear time and again, when your client is getting qualified by individuals like me, that the ultimate goal is to determine what the ratio is, the debt to income ratio, or DIR, sometimes it's called, or DTI, debt to income. Those are the vernaculars they use for this. And this is the ultimate number that will determine, one, if they qualify, two, which product are they going to end up with, and three, what interest rates are they going to get. Along with the other two things we talked about, which is FICO and down payment. But this, the ratios, is probably the most important. So for today, just remember that the maximum is 50, the most conservative is 40%, and for conventional loans at 45. If you remember those numbers in your head, write them down somewhere. When you're talking to your loan officer and your clients, you'll know when they say that, oh, okay, they either qualify or they don't. Just as a side note, are there ways that we can fix these ratios so that it could be more in line? Yeah, there's ways, and that's when the expertise of the MLO comes in analyzing the income documents as compared to the down payment, as compared to the interest rate, as compared to outstanding debts. It's actually, as you sit down there and do mathematical subtractions and additions to see how you can finesse that ratio to be in line with the guidelines. 40, 45, 50. Okay, let's talk about, any questions? None. Got to share my screen. Where's my screen? There. Way down there, and I forgot to share my screen. Sorry, guys. Okay, I am down here. There it is. This is the one in yellow highlight are information that's updated for today, actually. We are in letter GI, which is gross income versus after-tax income. Questions that I get asked by real estate agents and borrowers. We use gross income. For example, let's take a salary employee. If they tell me that they are paid $5,000 a month as a salaried employee, then we will use the $5,000 to qualify them, not the after-tax income. Because as you may know, or you probably should know, $5,000, they will have federal taxes, state taxes taken out, SDI, social disability, FICA, excuse me, any kind of contributions to health insurance and dental insurance, any kind of contributions to 401k, and then they'll come down with a net or after tax or net income. but no, we use the top, the gross, the 5,000 to qualify every client. That's on a salary or an hourly individual. On a self-employed, and they have business tax returns, it's a much different formula, and we will not go over that today. We can talk about it later on if you're interested. But just remember, on this side, the salary, the employee, we will always use gross income. Earlier, I touched upon how to calculate debt to income ratios, and we talked about now, I just identified to you, we take their gross income plus all their monthly payments on their credit card, car loans, auto loans, installment debts, add them all together, divided by the gross income is how we come up with the ratios. So it's debt divided by the income is the ratios. I hope that I'm doing this correctly and fairly today. Just know the concept behind it, the mathematical formula. You don't need to be concerned, but just know that that's how they arrived at it. But there's one topic here I want you to be aware of, because you touch this topic all the time, or most of the time. The PITI, principal, interest, taxes, and insurance. That represents the actual monthly payment on a mortgage that they're about to undertake. After we calculate the loan balance, the interest rate, the term, whether it's 20 years, 15 years, or 30 years, we come up with the first component, principal and interest, for that property that they're buying, depending again on loan balance, interest rate, and number of years, term. Then we calculate what the property taxes are for that particular house, and that is a function of where the house is, what county the house is in. In LA County, it's about 1.25% of the purchase price is the annual property taxes. And then the insurance, we do a rough calculation depending on what the value of the home is, and we plug in a number on what we think the premium is for homeowners or fire insurance. And that's how we arrived at PITI. And that is important for you today, because a client will always ask, what is my payment? But then I will always say, this is your mortgage, principal, interest, but let me share with you what your taxes and insurance would look like, because that really does encompass the full payment for that property. Then additionally, if there are any monthly homeowners association payments, if it's a townhouse, a condo, a planned unit development, a PUD, or just a closed community where they share some services, maybe a pool, a rec room, or maintenance of the landscape, there are homeowners association payments, and that would need to be added to that PITI if it's present. And the last piece is if they're coming down with less than 20% down payment, typically they will have monthly mortgage insurance payment as well. And we can talk about mortgage insurance payment, but it's added on to the total PITI. Okay, so far so good. And I'm looking for questions.
No questions yet.
Okay, thank you. Okay, the last topic on this particular page today is the Covet letter regarding employment. If you have closed any loans in the last 2 or 3 months, at the end of that closing, the MLO, like myself, will go back to the buyer borrower and will ask him to please prepare a letter regarding their employment. Basically, in so many words, it states that COVID has not affected their job, has not affected their income, has not affected their ability to earn income in the future, has not affected their job in the future, and everything is A-OK in so many words. There is a template, a sample letter that we all use to meet this requirement, but it is typically requested at the last day before closing, the day before closing or the actual day of closing, to be signed and dated by your clients. I share that with you because it becomes a surprise sometimes when it's not told to them up front, because it will be a requirement of funding. That's how important this is, why I'm sharing this, because if you don't do it, if I, the MLO, do not get it done, they will not fund the loan without this letter. There's reasons for this letter on the risk management side of the bank and the lender, but it is a hard requirement that needs to be done before closing, and they will actually pin you down, call you, find you, me, the MLO, if it's not present, and they say, oh, they won't fund without it. So just keep in mind that that's how important that letter is today. Will it go away in the future when we are, if we get out of, or when we get out of the COVID environment? Probably so, because we never had it before. It is today's additional requirement because of the pandemic. Okay, we're almost there. I'm gonna go down to the bottom page. I think, yep. Okay, so that last information session that we just talked about pretty much covers the high-level concepts behind income for your purposes and for your clients' purposes and for your understanding. But I always like to tie it in as to why that is important. To recap, in the past few sessions, we talked about the total mortgage 101 landscape and what that means to you and how that affects your transactions. We talked about the credit, the FICO score. We talked about appraisals, collateral, and today we're talking about income and employment. So those three things pretty much makes up in general concepts today of what we do to underwrite and approve a client for a loan. Obviously, it has more details, more technical information that gets down much deeper dives, but for your purposes, these are good vernacular and tools and concepts to understand, so that when you're dealing with your clients, you're dealing with the MLO on both sides, because if there's a buyer and a seller and the seller is also buying, you'll be bombarded with this information. It is important, again, here we go, just a reminder, whether you're making an offer or reviewing an offer, we talked about a nice, clear, and legible IRPA. We've hammered the FICO scores. We've talked about having a pre-approval letter in which the MLO will do all these things we just talked about to see if they qualify. Before, we've talked about the desktop underwriting, which is the automated system that takes the information of a borrower, puts it into this matrix, and kicks out whether they think it's an approvable loan or not. There is also, in yellow in your screen, called the loan prospector, which we've never talked about. It is almost the same as desktop underwriting, or DU. It's called loan prospector, and it's an LP. There are certain reasons why banks or lenders will use the LP. It's because it has certain advantages. We don't have the time to go over today, but I just want you to know that there are two systems used on borrowers as far as getting an automated approval. One is desktop underwriting, and the second is loan prospector. Either one works. It's just a matter of the purpose of the loan, or some kind of like nuances that the loan might have, that why they would go to one or the other. We talked about in your offer the proof of funds. Just a reminder again, you need 2 months seasoning. They will always ask for 2 months. In other words, if the bank statement on 1 month shows the money, but the 1 month prior doesn't, we have a challenge. The last, or second to the last, this one was covered by our broker the other day, Rich. Letter to seller from buyer. It used to be just not a problem. You wrote a letter, you make it part of your offer, you send it in. Today, and please refer back to Rich's informational webinar a week ago or two. Today, you cannot just arbitrarily send that letter from the buyer to the seller. There has to be consent. And I'm not the expert on the legality of this, but per Rich, you have to have consent in sending this, and if you're the listing agent, you have to have consent in showing it. So just be careful. They're not telling you not to do it. They're just telling you to make sure you cover yourself in getting written consent from the parties that are involved with this letter. And then the last thing, and this is where I throw in my 2 cents, whether you're making an offer or reviewing an offer, I'm here to either qualify your client for an offer, or cross-qualify an offer that you're getting to make sure that what the information that they're being given to you is accurate, and we know, or we can have sufficient reliance that it will close, on a timely manner with as little or no headaches as possible. That covers me today. I did it all in 30 minutes. I have plenty of time to answer any questions if you do. Again, this sheet that you're looking at on your screen is available. It was uploaded by Kim Jordan. I can also send it to you if you'd like. Other than that, I have completed today's lessons.
Great timing.
I tried to.
I don't see any questions on Facebook, but there is a bit of a delay. Oh, there's Stephanie. I'll let her take over.
Yeah, so I've been watching Facebook. Great content, Jojo. Thank you. And I don't see any questions at all. We had a good group on here, but no questions. So that means that you're super thorough.
Okay.
All right. So thank you
It's
so much,
recorded, though,
Jojo.
right?
And
Huh?
then everybody has, you want to type in, oh, you don't have the chat. Hold on. I will type in the thing, your email at, or not your email, but your telephone, your cell phone number. So then people, if they have any questions, they can reach out to you and you can help them with any and all their needs.
Okay, awesome.
All right, you're awesome. Thank you so much, Jojo.
Okay.
All right, thanks, Patricia.
Thank
All right, bye-bye.
Bye.
Bye.